Welcome to The Explainer. Today, we're going to tackle a question that probably drives every crypto investor a little bit crazy. How can the market be in a total collapse 1 minute and then a perfect bull trap the very next? We're going to break down these mixed signals and try to find the logic hiding inside all that chaos. I mean, seriously, how is it possible that within 24 hours, you see two completely opposite headlines just like these, sometimes from the exact same analyst? On one hand, the market is in a total collapse. Then on the other, that exact same price dump is being called a trap. So let's dig in and figure out how both of these things can be true at the exact same time. All right, first up, let's look at this whole total collapse idea. And look, this wasn't just some random panic. It was actually driven by some very real and frankly pretty alarming data that had people scrambling for the exits. Okay, so a huge red flag shot up when Bitcoin ETFs saw a net outflow of over $500 million in a single day. To put that into perspective, BlackRock's fund by itself had investors yanking out $373 million. That is a ton of selling pressure hitting the market all at once. And it wasn't just the outflows. On top of that, you had this perfect storm of technical warning signs brewing. You had the price breaking below this really crucial support level, a key weekly trend indicator just flipped to red, and this massive long-term bearish signal still active. Throw in some weakness in the stock market, and suddenly all signs were pointing to one place. The next major support level could be way down around $53,000. Yeah, this feeling got so strong that the analysts were actually following. They closed their own long position on Bitcoin. They saw the writing on the wall, followed their own analysis, and basically decided, nope, the risk of a much deeper crash is just way too high right now. But then, and this is where it gets wild, just one day later, the entire story does a complete 180. The whole collapse story was out the window, and now everyone was talking about a trap. Let's see how the exact same price move could be seen in a completely different light. So what changed? Well, here's the thing. Nothing. Nothing fundamental had changed. The price was still way down. Those ETF outflows were still a fact. The only thing that really changed was the interpretation of the data. The whole perspective shifted from a market in total freefall to a calculated, even intentional maneuver. The new theory all revolved around this one key idea, something called a liquidity grab. The thinking here is that the price dump wasn't a sign of some organic weakness in the market, but more like a calculated move to shove the price down, trigger all those stop-loss orders, and let the big players swoop in and buy up Bitcoin for cheap. And you can really see the tactical thinking here. So the price hits that target zone, a key momentum indicator called the RSI starts screaming oversold, and this historical price pattern they were watching was still holding up. And boom. The same analyst who was bearish just a day ago throws down a new $200,000 trade, betting that we're about to see a bounce. Okay, so this gets us to the absolute heart of the matter when it comes to understanding these mixed signals. It's all about understanding the huge difference between a short-term trade and a long-term market outlook. Because believe me, they're not the same thing at all. So, you see, the analyst wasn't actually contradicting themselves at all. Their bigger picture view, the idea that the market is still fundamentally weak over the long haul, that didn't change. They were just making a quick, tactical trade to try and profit from a little relief bounce inside of that much larger downtrend. Here's a great way to think about it. That short-term trade is like predicting tomorrow's weather. It might be sunny, right? Even if it's the middle of the rainy season. The long-term view, though, that's like studying the climate. It's about understanding that, yeah, you might get a few sunny days, but the overall season is still rainy. So if we want to really get a handle on the market's climate, we have to zoom way out from all this daily noise. And a perfect way to do this is by looking at crypto's second biggest asset, Ethereum. And we're not talking about the last 24 hours. We're talking about its entire history. And wow, this timeline really shows off Ethereum's incredibly violent but also kind of predictable cycles. Look at this. It peaked at around $1,400, then crashed all the way down to just $80. Then it rockets up to a new high near $4,900, only to come crashing down again to about $900. These boom and bust cycles are a really powerful long-term pattern. Okay, and check this out, because this is the key piece of data from that pattern. That first big bear market, a jaw-dropping 95% crash. The next one, while still, totally brutal, was a bit less severe at an 82% drop. This trend of diminishing but still devastating bear markets is really crucial for thinking about the future. Now, the analyst points out that, yeah, Ethereum has been a massive underperformer this cycle. So you take that fact, you combine it with this history of slightly less bad crashes, and it leads to a pretty sober, data-driven prediction for where Ethereum might bottom out next. And that target is $1,000. Yeah, a drop to $1,000 from its all-time high would be roughly an 80% crash. It's a number that not only fits that historical pattern of less severe bear markets, but it's also a huge psychological number for investors, a real line in the sand. All right, so we've got the short-term panic, we've got the quick tactical reversal, and then we have this super long-term historical view. The big question is, how on earth do you put all of these pieces together and make any sense of the noise? You know, this table actually does a great job of breaking it all down. The bear case and the reversal, those are both short-term plays. They're all about trading the weather, looking at a time frame of just days or weeks. But the historian, they're not trading the day-to-day at all. They're studying the climate, looking years down the road to get ready for the next big cycle. And honestly, this is the single most important takeaway from all of this. A bearish outlook for the next 6 months and a bullish trade for the next 2 weeks aren't contradictory ideas. Not at all. They're just different games being played on totally different timelines. One's a sprint, the other's a marathon. So at the end of the day, this is the question you really have to ask yourself. Are you trying to be a weather forecaster, or are you trying to be a climatologist? Because knowing which game you're actually playing, that is, without a doubt, the most important skill for cutting through all the noise and finally making sense of crypto's crazy mixed signals.